Hey investors, Ken here from the Dyslexic Investor, and we're going to be looking at some mistakes, 5 mistakes, maybe 6-ish, that I see that follows in my trading, in my journey on trying to become a more consistently profitable investor, trader, and kind of just help some of the beginners on to trying to get some action items to be looking out for. Okay, let's just dive right in here. So this is the Apple chart. Looking at the daily for 1 year, you can kind of see here hit its high here in October, and then since that time, it kind of made its bottom here in the beginning of 2019, and then since then, it's kind of made like a V-shaped bottom and making its way much higher. And this falls into the very first step that I see a lot of people fall into is the FOMO. So the FOMO stands for the fear of missing out. That could be on the long side, that can be on the short side. Particularly here, I'm pretty sure there's quite a few people, you can kind of see here on the volume, who bought into this area here. And about the same time, these people probably got out around the same level they got in, which is right about here. Or they could have bought more. You can, I want to bet the psychology of this is they probably bought more here before it just totally came crashing down, going from like 220 down to 142. That's a heck of a decline there. And then beginning of the year, Apple the report came out saying, hey, it's actually, we're still making a lot of money on services, and yeah, the iPhone's kind of slowing down, blah blah blah. So you had this word again, the fear of missing out right in this area here. You can kind of see with this yellow box, this consolidation on people like, oh, piling in after the earnings report. It jumps significantly higher from like 155 to almost 170 and higher to 175, kind of does a slight pullback and then consolidates, and then another ginormous push higher into almost the 200 area, which I think it's more or less likely going to be heading, and could have a lot of potential resistance from there. But I'm just glad to see it break through the 200 here, the simple moving average with the white dots. And this kind of falls back into like the second thing that I kind of see myself do in my journey is sometimes just make unrealistic projections. No one knows which way the market's going to be going, up, down, left, right, whatever. And just kind of, instead of putting my spin on what I can see happening, but just kind of doing to my trading plan. So 2 and 3 kind of falling together is to have my trading plan, and the trading plan continuously updates and gets changed, but looking at the overall market. So jump to the S&P 500 here. Let's I can make a little more standard chart here. There we go. This still looks a lot. Let's just go here. So again, the same time around October, due to the Fed saying they're going to raise rates, this ever since then is kind of having like a downward moment, and now they're completely bullish or dovish, and it's just been continually going higher since then. Again, the fear of missing out, and then with these huge swings of up, down, again, like just in this area here, just up, down over here. If you don't have a trading plan on trying to capture the movement up and down, or if you're just trying to buying up here and then selling down here, that's not a trading plan. You got to have some steps on how to trade and taking the emotions out of it. So that's like number 4 for me, where I see a lot of people without a trading plan, without a setup. So let's just zoom in here. So the last like 2 weeks here on the S&P 500. So let's say I was going to try to buy some S&P 500, get into the market. I was going to make a trade for the next 2 months or so. So if I get in here, let's say I just bought in on the 27th of February. on an up day. Actually, on my trading plan, I say I don't buy on up day, so I should have bought on those like a lower day. So let's just buy a bot at like at 27.85. And then as soon as before I even execute and send that order to the market, I want to know when do I get out and when do I take my profits. So for example, my get out would have been it closed below the 21, and my get out would have been right above the 28.30 level, because I have this as a pretty significant area up here. You kind of see here it's kind of actually a little bit lower, so it would be like this 28.15, 28.12 level of trying to take some profits. And it's not the greatest example because I am trying to capture just a little bit, but if I'm just trading this for like the next month or so, just selling some puts or buying put credit spreads, or even just buying some SPY stock on a nice push through that level and potentially going higher due to a lot of the Fed news and so forth. And then if I didn't, again, that's if you had a trading plan, but I feel like 90-85% of people don't honestly do that. And again, it goes into emotion. So as soon as they see a nice up day, they might just take the quick profit, which quick profits is somewhat okay, but it can get you in a lot of trouble, because usually if you take quick profits, you don't let things just kind of fall. So let's say you kind of made a little bit, you bought in here, and then you kind of rose up a little bit, and it kind of sold off. So that's a kind of a big wick here. So that the whole red line is what the trade was that whole day. So it traded from like 28.20 all the way down to 27.75-ish, 68-ish. So that's a huge, that's like 50-60 points right there, movement in a day. That's a lot. And even if you bought it in this is buy at the top here, and it closed right here. Still didn't close below the 21, so you should still be in longer term. If it was a day trade, you probably should have got out, because this huge tail right here is kind of a sign. And then that continues the next 2 days, completely going lower. So this day, I should have gotten, if I traded on this marker, would have been in my get out of Dodge kind of thing. But then if you trade your plan, again, this is why your trading plan kind of has to correlate with how you trade, how you invest, how you look at the market. Are you able to look at the market every single day? Are you able to look at it for an hour a day or so forth? Are you able to look at it for more than an hour in a day? A lot of people, the trade literally they look at the market the whole time from 9:30 to 4 o'clock. So again, this downturn should have been opportunity if your trading plan was like, okay, I'm going to see how it interacts with the 21. If it closes below the 21, which it kind of did for 2 days, it's a sign that it potentially could go lower. Or if my trading plan allowed it, I would have added more and watched for the swing higher. Or if it went any lower and so forth, you can kind of go down the rabbit hole with how your trading plan works. I found out with myself, trading short term like this is not good, because my emotions just get the best of me. I second guess myself. I go back to number one. I do the FOMO. I do the unrealistic goals and projections of like, oh, like it can't go lower. There's no way. It's a bull market. It's got to go higher. The trend is higher in the past. You can kind of see here it's been going up. It's just going to touch the 21 and continue to go higher. And in hindsight, yeah, that would have been correct, and I could have made a nice, decent profit if I took that trade. But this area is the days where you're like, oh my gosh, you're slapping yourself. Like, what am I doing? Like, why am I trading? What's going on? The market hates me, and all those emotions just dig into you like 1,000 paper cuts, and it's aching, this pain. And I don't like to deal with that kind of emotional stress. I like to sleep at night, So these short-term trades are not for me anymore. Like I like to trade much longer term than a couple of days. And again, if that's your trading plan, I know people who do this day in, day out, just trade, that are day traders, and they do fantastic at it. That's not for me. I'm not able to sit in front of the markets all day and do that. More power to them. But these are just some couple little things that I just want to highlight to a couple people on some mistakes that I see, that I see myself do day to day still, and looking at the overall markets and so forth. To give you another example, so let's say the longer term view of Apple. If timing, as you can know for a lot of things, is timing is very important when you're going into the market. Again, a lot of my trading revolves around this yellow line, so this 21. So if I wanted long term to buy Apple, I would have probably bought here on this consolidation phase here, because you can kind of see here it kind of broke to 21, but it kind of held the 89 EMA right here. Then you start seeing a lot of ones cross. So this is, I'll be building up a position here for like a couple months, a return or so forth. So building it up here, it's consolidating, it's above the 21, continue to hold. It tested the 21 again. I'm doing it for more than a couple days, so I'm doing it months out. It has to completely break and get below where I initially was of the 89 and continue to go up. It has a fantastic earnings and it continued to climb up. So ideally, in a perfect world, you'd be scaling out of, if you had 10, just make it simple numbers, 10 shares of this. You're getting, when you see a big pop like this, again, right when you enter, you know when you want to get out. Like if I'm up 20% in 10 days, you should probably cut some off and take some of those profits. So you're getting out here on huge green days like this. You're getting out on huge green days like this. Again, you might have missed all this, but you still you have such a couple shares still left. So once it pulls back to the 21, you don't want to be greedy. You can see here it kind of consolidates. It didn't close below the 21, so my plan would have allowed it, but it closed here, so I would have gotten out here. So I still would have gotten a little bit of profit here and so forth, but it would continue to go on higher. Again, you can't capture everything. That is the fear of missing out. You're just gonna not catch every single move, and the trading plan doesn't allow me to do that. So not letting my emotions of like, oh, I could have made another, what is that, $15 to $20 per share on that, But guess what? These red days, I would have made more. I would have saved my capital, because the way I look at my capital is I want to cut my losses as quick as possible. Even though that I can jump in the next day or the next week, it's just a commission away. So I just want to kind of be mindful of that. I want to kind of go deep into how I trade and how I invest, and kind of show it on more on like a black and white way of how I do it, with a little more better understanding of graphs and so forth. I'd like to thank everyone so much for watching. I'll be posting videos more about my lovely journey of an investor in trading in this crazy market. And if you guys have any comments, throw them down below, and don't forget to hit that like button, subscribe. This is Kenneth. Catch you guys later. Peace.